Now, obviously, in this day and age, we have rising interest rates. People are really feeling pinched at the moment. So sometimes it can be hard to even think about investing at a time like this. According to the latest Lending Club report, 62% of US adults are living paycheck to paycheck. So Tonya, I want to start with you. Talk about the tools that MyFab Finance has seen the most success with in breaking that cycle of paycheck to paycheck.
Yeah, I mean, I think that when we first started MyFab Finance, it was in 2013. And so people thought they were living paycheck to paycheck then. They're actually living paycheck to paycheck now with the environment that we're in. I would say that the biggest tool actually has been community. And that is because community opens up space for conversation around what you're navigating. It allows you to ask questions. It allows you to ask for support in the areas you need support in. And I think that as well-meaning as financial services companies are, they don't necessarily understand some of the nuances that consumers are experiencing on a day-to-day basis. So having that community, they can talk to someone else who's been in their situation. And we've created the Blue Ribbon Club with MyFab Finance. We've created the Triumph Club as well for people to actually talk about what they're navigating.
Because it's difficult. It's one of those topics where if you are struggling with your finances, you're not usually going to share that. Perhaps you might not even be aware of the state of your finances.
Yes, I think that's how it was in the beginning. I know when we started in 2013, that's how it was. But I just find that this is a completely different landscape, and people are more willing to share what they're navigating with their personal finances, and there's less stigma around it.
It's true, and certainly a lot more access to information as well. So Haley, I want to bring you in here because once you are able to cover your essentials, you're not living paycheck to paycheck, you do have a little extra money to put to work. People want to invest. How do you even come up with your initial portfolio strategy?
I mean, I think first and foremost, you have to look at your risk tolerance and your time horizon. But then, when you're first starting to invest, usually what happens is you have a lump sum haunting you in your checking account that you're like, okay, I should do something with this money. It's staring me in the face every time I open it. I should put it to work, I should put it to work, I should put it to work. So finally, you put that to work, great. But what happens the next month? What happens the month after that? Investing is not a one-time thing. So it's really important also to look at your budget and figure out every single month how much can you put towards that future you so that you are consistently building towards building wealth.
And is that something that you find that people sort of set it and forget it and they don't take advantage of things like compound interest in their portfolios?
Oh, I mean, I've seen everything. I've seen people, putting money into accounts and then not actually investing it, which happens a lot with retirement accounts just because there's not enough financial education out there. So people think, oh, if I contribute to my 401k, then I'm investing it. But then you retire and you have 350k instead of 3 million because it never actually was put to work. So, but yeah, I think definitely what's important is making sure that every single month you are putting money into your investing account and then actually investing it.
I mean, certainly can't just leave your money sitting on the table, literally there. So, Tonya, when consumers are looking to financial service companies to support them, when it comes to adjusting for this very well-telegraphed recession that's debatable whether or not we're in one or not, and a higher interest rate environment, what are some of the things that consumers should expect from some of these companies to really support them to adapt here?
I mean, I think they should expect, regardless of what the environment is, they should expect quality service. And to Haley's point, I think that a lot of times, especially now in this environment, because we have TikTok, we have Instagram, a lot of people are getting their financial advice from the internet. I think that it's really important to understand, how do we get this person from saying, all right, I have this money, I'm putting it into a savings account, to actually taking action beyond that? Because they might feel that their job is done and it isn't done. And who are they going to be upset with? The financial services company. And so I'm not sure what that looks like as far as ensuring that people are getting their intended outcome met, but checking in with the consumers and asking them, hey, what was your intended outcome with this action, and how can we make sure that that occurs? Because otherwise they're going to say that the bank, didn't do right by them, or they're going to be angry at the bank when it really was actually a consumer error.
And it's hard because even though technology has allowed us to access different tools, different platforms, some of the financial literacy and education that goes along with that, it allows you to take risks a lot faster and perhaps getting in a little bit over your head if that's not balanced out.
Yes.
And so then for Haley, people looking for some direction here. I mean, there's fear of missing out. People looking at the Magnificent Seven tech companies saying, should I jump in here? Have I missed the boat? It says AI in an earnings call. Is that what I should be heading for? What are the keys, though, to knowing when and how to rebalance your portfolio, depending on what's going on with the economy?
Well, I mean, I think it's very easy with all of the fear mongering to think that maybe you should rebalance your portfolio every hour. Go in there, make a tweak here and there. But, if you do that, A, you're going to get screwed with capital gains taxes or, the other capital losses. And you're also going to miss out on compound interest. So really setting it and forgetting it, and then rebalancing every year or so works for most people. But don't pick your face if you have like any pimples or anything, and don't touch your face and don't touch your portfolio. And that works for people. They like that. So
it could be harder because a lot of people are looking at their 401ks. And they're like, what do I do? I'm seeing, my investments are falling off. How do you stop people from panicking? Like when you're talking to your clients, Tonya?
I mean, historical data.
Yes.
I think that the numbers always tell the story. Historical data, we've seen this before, write it out. Just let them know, I actually know more about this than you do. Write it out. Just giving them that you have the confidence and that their strategy is going to work out for them. I mean, nothing is perfect, right, at the end of the day. But you came to me for information because you trusted me. Trust me along this process, but let's ride it out.
And it's also the volatility is the fee that you pay for getting to grow wealth in the market. That's really what I say too. It's like,
it's your tuition.
That's the price, exactly.
Similar to the cost of doing business, it's the cost of investing.
Exactly.
You're going to learn one way or the other.
Yeah.
Now, something I want to talk about is something that's traditionally been fundamental to the American dream when it comes to building wealth, and that's real estate. But I want to tap in on what we've seen with mortgage rates, especially as we look at, I know we have a graphic here on some of the changes that we've seen. Say if you have a $400,000 house with a 30-year fixed mortgage, what you would have been paying back in 1999, $1,896 a month. You currently would be paying that in 2023 about $1,000 more. So Haley, when you're trying to figure out, do I need to buy a home? Is that the best way to build wealth? Is it that, or at this time, should it be a focus on the stock market?
I think that there's a lot of leftover financial advice from boomers that needs to be rewritten for millennials and Gen Z because we're in a completely different world and economy. And so whereas, as you were saying, for them, it was the American dream and it was a great investment to buy a house. Like there's a really funny meme online that's like me thinking about how if I had been, if I had more money and had just been born in the 1960s, I could buy a house. It's not even your fault. It's just when you were born.
When you were born, literally.
Yeah, exactly. And so I think that, but I think a lot of people feel shame renting because that stigma still remains. And like there is still this idea that owning a home is the American dream. But I'm here to tell you it's not. I'm a millionaire and I rent, and Lord knows if I buy a property, it's not going to be in New York City. So, and like say it loud and proud, like we don't need to buy real estate in order to grow wealth. Stock market has a much lower buy-in. So, and if you put your down payment money into the stock market, a lot of data shows that historically you're going to make more money, especially because when people calculate the gains that they make on real estate, they're never actually thinking about all the money that they put into their property. Oh my God, the HVAC and the boiler,
the landscaping,
that. It's like, oh my gosh, you have to be so liquid. So get your money in the stock market and get yourself a landlord.
I love that question, though, because I think that, we come from a generation. Actually, I just sent a link to my father about how expensive it is to buy a house now. And I decided to sell both of my houses because, I don't want to be a homeowner.
There you go.
I was like, I don't want this right now. I want more predictable overhead. And I think that it's extremely important for people who have been able to achieve a certain amount of success outside of homeownership to be vocal about that. And I think we are seeing a change in how we create wealth. Now, for some, real estate, especially if you got in in a timely manner, real estate is a vehicle for wealth creation.
Totally.
But the opportunity exists that there are so many other ways for you to create wealth. And it is up to content creators and strategists like Haley and myself to inform our audience about that, as well as financial services companies to present them with other options as well.
And I know you'd had a change of heart about that in terms of how you used to view owning real estate.
Yes.
Are there any sort of financial circumstances where it does make sense to invest in real estate?
I think you find a great deal. If you find a great deal, if property is passed down to you from a family member, but if you find a great deal, and we always say money is made on the front of a real estate deal, not in the back. So if you do find a great deal, then it makes sense, but that you have to understand what a great deal is and who benefits from you accepting that great deal too.
Yeah.
and what their ulterior motive is. So yeah, definitely, in some circumstances, it does make sense. But in quite a few circumstances, especially right now, it does not make sense.
And Haley, we've been talking about some ways that people leave money on the table. We were talking earlier when it came to checking accounts, sort of just leaving it there, not really maximizing it. Another aspect of building wealth, though, and maximizing what you already have when it comes to tax strategies. So break down the strategies and the types of accounts that investors should be taking advantage of right now.
I'm like pretty strict in my advice about what accounts you should open and the tax strategies that you should use, just because I think that it's confusing, but it actually can be quite simple, which is like, great, max out every single tax advantage account that's available to you before you even think about opening a taxable brokerage account. That means your 401k, your 403b, your IRAs, Roth, individual, whatever it is, health savings account. No one knows that that's an investment account. It's a really good one. It has more tax advantages than IRAs and 401ks. So max out all of those before you put money into individual brokerage accounts, because Uncle Sam is super greedy. And if you're gonna find a loophole, like, you better use it. You know what I mean? And there's also ways that you can grow wealth for your children that's tax deductible too, which I know we were talking about earlier.
So break that down, because a lot of people perhaps don't understand, not about just like putting your kids to work, but also making your money work for you on behalf of your children.
Yes.
So break down some of that, because a lot of people aren't familiar with these strategies.
Oh, I am like low-key an expert on growing wealth for children, and I don't have any. So if you want to hit me up later, I can give you some info. But I have a goddaughter, and that's what sort of spurred all of this. But I was like, wow, it's very simple and does not take that much principle to make this girl have like $8 million tax-free by the time she's 65. We literally just have to make sure she has a paycheck, which was, her parents have their own business, so that was easy, but you can also scoop ice cream, work as a caddy, whatever it is. You just need a paper trail that shows that you have your own business. And then there are Roth accounts that are for people under 18 called custodial Roths. And so if you max that out every year, you're gonna, by the time that they're 65, that's gonna be millions of tax-free dollars. Yeah, and there's also, of course, 529s and other accounts that you can use as well. But what's amazing is that the compound interest, like if you set it and you forget it and you invest like $100 a month for your child, starting when they're a baby, oh my gosh, they are going to have so much money by the time they're in their 60s.
See, there you go. Get your family all on board. Get everyone to buy in on this. Tonya, I want to ask you, because at the end of the day, this is about better accessibility to building wealth and investing as well. So some of the trends that you're noticing in how some of these industry, specialists as yourself, and we're sort of seeing also more competition as you look at things like AI and robo-advisors and all these different things. What are some of the trends you think are going to be shaping the next evolution of this?
Yeah, I mean, I think AI, of course, you can't talk about anything, in technology without talking about AI, but I think that consumers still crave a hands-on, or they still crave that intimate experience, or they want to feel like more than just a customer. They want to feel like you're invested in their success and that you have tools specifically designed for them. So I think that consumers are actually going to want even more specificity when it comes to the products and how they engage with financial services companies. And I think that it is important for companies to understand, there's a whole generation of content creators, and a lot of people get their financial advice from content creators. I started out in the organizing space and then moved into financial education as a financial education instructor, and people began to trust me more than their banks because I was a person who had navigated what they had been through. So I think it is important to understand, how do we leverage this at the decision-making process as a financial services company? Because Haley and I are people who are working with these consumers on a daily basis. We understand what they're afraid of, and we understand what they want from financial services companies.
That's very important when you think of sort of the distance sometimes between your financial advisor who perhaps hasn't had the same sort of experiences and understands the struggle. So I appreciate you breaking that down. We only have about a minute left, but I just want to quickly get each of you with a 20-second takeaway for people who are thinking of entrepreneurship as the path ahead to build wealth. One quick phrase that sums up what they should be thinking about if they're thinking about that as a path forward.
Ooh.
Accountant.
Very important.
I would say exit strategy. Start with the exit strategy in mind. Yeah,
That's
very build
important.
with the extra strategy.
That's something
in
that's
mind.
very, very underestimated. A lot of people get in and haven't even figured out the route out.
You just find yourself in it. Some people are intentional about entrepreneurship. Some people I found myself in it coming from nonprofit. And I was like, wow, I don't know what I'm doing. And I had to learn in the process, and it is not for the weak.
It is not for the weak. You will work harder for yourself than you will ever have to work for anyone else. So get ready.
Yes, life-changing, but extra strategy.
Yes.
Well, unfortunately, that's all the time we have, but please give it up for our amazing panel. They've been fantastic. Thank you, ladies.